Welcome to FinScan Academy. Today, how to analyze a stock before buying, a practical guide for Canadian investors. We will turn the full guide into a practical checklist. Analyzing a stock is more than finding a company with a rising share price or an attractive-looking ratio. A share represents part ownership in a business. Before considering the market price, it is worth understanding how that business earns money, how financially resilient it is, and what could change its outlook. Research cannot remove uncertainty or prevent losses. Its purpose is to make the decision process more disciplined. Compare like with like, test assumptions, and look beyond a headline. For Canadian-listed companies, primary disclosure documents can often be found free of charge through SEDAR+, the Canadian securities filing system. Start with a plain language description. What does the company sell? Who pays for it? Where does it operate? What drives sales, costs, and cash flow? The key questions will differ for a bank, mining company, retailer, real estate issuer, or software business. A ratio that matters to one may have little value for another. Then consider the company's competitive position. It might be supported by a recognized brand, a lower-cost operation, distribution reach, long-term customer relationships, licenses, intellectual property, or scale. It can also be weakened by customer concentration, a commodity price dependency, a new competitor, or regulation. If the business model is, the investor relations section of a company website is convenient, but issuer filings should anchor the research process. Look for annual audited financial statements, interim financial statements, management's discussion and analysis, MD&A, earnings releases, annual information forms where available, and management information circulars. The Autorité des marchés financiers explains that financial statements, the MD&A, notes, and the independent auditor's report each serve a different purpose. The statements provide the accounting record. The MD&A sets out management's discussion of results, financial position, and outlook. Reading them together helps an investor assess. Net income matters, but it is not the same as cash received. A profitable company can still have weak operating cash flow if receivables or inventory are rising sharply. Conversely, a growing company may spend heavily on productive capacity without that automatically being a warning sign. The trend over several periods and the economics of the industry matter more than one isolated line item. Do not skip the notes to the financial statements. They can explain revenue recognition policies, acquisitions, debt terms, commitments, legal matters, accounting estimates, subsequent events, and more. Get smarter about money notes that the accompanying notes may contain material. Compare several years of revenue, gross margin, operating margin, net income, and operating cash flow. Then identify the reason for meaningful changes. Was growth caused by higher volumes, price increases, lower costs, an acquisition, a favorable exchange rate, or a one-time gain? Did profitability fall because of a temporary issue, or because the business became less competitive? Adjusted measures such as adjusted EBITDA or adjusted earnings can be informative, particularly when used consistently. They are not substitutes for standardized financial statement measures, however. The AMF cautions investors to remain critical when items labeled unusual, rare, or one-time. Before acting, compare costs, diversification, risks, tax treatment, and fit with the rest of your portfolio. Read the complete guide at https://finscanpro.ca/n/articles/how-to-analyze-a-stock-before-buying. Subscribe for the next FinScan Academy guide. Educational content only. This is not personalized investment advice. Investing involves risk.